Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ALTI Global Inc. Annual Report. ALTI Global Inc. offers a wide range of businesses and services that cater to the financial needs of individuals and institutions. At its core, the company provides wealth and asset management services across various countries, including France, Hong Kong, Italy, Portugal, Singapore, Switzerland, the United Kingdom, and the United States. The company operates through two main segments: Wealth and Capital Solutions and International Real Estate. Within these segments, ALTI Global offers a variety of services that include discretionary investment management, non-discretionary investment advisory services, trust services, family office and administrative services, and ancillary fund management services. In terms of specific services, the company provides clients with estate and wealth planning, family governance and education, philanthropic and strategic services. It also assists money managers in building their fund management businesses through its alternatives platform. Additionally, ALTI Global offers international real estate services that include co-investment and fund management services. Overall, ALTI Global's diverse range of services makes it a comprehensive financial solutions provider for individuals and institutions seeking wealth and asset management expertise. ALTI Global Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. ALTI Global Inc. trades at a higher price-to-book ratio of 1.56 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 26% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in a company's financial performance can be categorized into three main groups. Firstly, revenue-based performance targets include earn-out liabilities, incentive fees, and revenue share agreements that are contingent upon future revenue growth. These factors directly impact the company's ability to meet its revenue targets. Secondly, investment-related drivers encompass management/advisory fees, distributions from investments, and external managers' DCF valuation technique for investments. Changes in these areas can significantly affect a company's revenue growth or decline. For instance, an increase in management/advisory fees receivable can boost revenue, while a decrease can have the opposite effect. Lastly, acquisition-related drivers include acquisition-related compensation expense, deferred compensation, and earn-out liabilities. These factors are often tied to specific performance targets and can impact a company's ability to meet its financial obligations. By understanding these primary drivers of revenue growth or decline, companies can better navigate their financial performance and make informed decisions about future investments and strategies. Net income and profit margins changes. A summary: the net income of a company underwent significant changes across various periods. Initially, it decreased from $102,248 to $123,717, indicating a decline in profitability. However, there was an improvement from $13,287 to $11,092, suggesting a reversal of fortunes. Nevertheless, the trend soon reversed again, with net income decreasing by 16% from $103,034 to $119,699. The profit margins also experienced fluctuations. The adjusted EBITDA margin improved by 44.7%, indicating an increase in profitability. However, operating income decreased by 25%, suggesting a decline in operational efficiency. Furthermore, the potential costs associated with acquisitions and administration/insolvency of international real estate businesses may have negatively impacted profit margins. The overall trend suggests that net income was generally decreasing across various periods. Profit margins were affected by several factors, including fee reductions, increased compensation for investment professionals, higher percentage of revenue paid out in the form of compensation, and fluctuations in foreign currency exchange rates. These factors contributed to a decline in profitability, highlighting the need for the company to address these issues to improve its financial performance. The company's financial performance indicates a concerning trend regarding its operating cash flow. For the years 2024 and 2025, the company has consistently generated negative operating cash flow. This is evident from the net cash used in operating activities, which stood at $51,437 for 2025 and $16,188 for 2024. Furthermore, as of December 31, 2024, the company's cash balance was $34,464. These figures suggest that the company is struggling to generate sufficient cash from its operations, indicating a potential liquidity issue. The company's debt level and interest expenses have undergone significant changes in recent years. According to the extracted summaries, the total debt, liabilities, decreased by $21,492 from December 31, 2024 to December 31, 2025. This reduction in debt is a positive trend for the company. In terms of interest expenses, there has been a substantial decrease. The interest expense dropped significantly from $22,134 in 2024 to $347 in 2025, representing a decrease of -$21,787,000. Additionally, cash paid during the period for interest payments on term notes and lines of credit also decreased significantly from 2024 to 2025. Overall, these changes indicate that the company has made progress in reducing its debt level and interest expenses, which should have a positive impact on its financial health. ALTI Global's management is optimistic about the company's future prospects, driven by a clear strategic vision. The key theme of global expansion is evident in their plans to expand operations through strategic acquisitions, particularly in Southeast Asia. This move is expected to increase revenue from management and advisory fees, which have been growing steadily over the years. Management prioritizes delivering strong risk-adjusted performance through a disciplined manager selection process. To achieve this goal, ALTI Global focuses on near-dated, hard catalyst events such as hostile deals and activism, with investments primarily in highly liquid and marketable securities. The company also emphasizes the independence of its investment management and advisory services. In terms of operational efficiencies, management has identified material weaknesses in internal control over financial reporting, ICFR, and is addressing them through remediation efforts. This initiative is expected to incur additional costs for external auditor assessments and completing the remediation plan after December 31, 2026. Overall, ALTI Global's management outlook and strategy are centered on expanding its global presence, delivering strong risk-adjusted performance, and prioritizing the independence of its investment services. The company's focus on operational efficiencies and risk management is also evident in their use of various valuation methodologies and fair value hierarchy to determine fair value. The company has made several strategic acquisitions and divestitures over the past year. In terms of acquisitions, the company has invested in various external managers through strategic investments, with potential for future fund vehicles to own existing or new investments. Notably, it acquired Contura Family Office GmbH for $15.7 million on April 30, 2025, as well as ALTI Global's earnout liabilities from Envoy and Contura. Additionally, the company was involved in a business combination with an unspecified date, which required divestitures of certain assets. On the divestiture side, the company disposed of its international real estate segment on July 11, 2025, exited management of Home Long Income Fund, HLIF, in 2024, and sold its advisor role for Elzai REIT plc to London Metric Property plc between January and March 2024. The company has a history of rewarding its shareholders through dividend payments and share buybacks. In terms of dividends, the company has consistently paid out to its investors, with notable payments made in December 2024, $11, and December 2023, $3,372. This demonstrates the company's commitment to returning value to its shareholders. In addition to dividend payments, the company has also engaged in share buybacks. Notably, in August 2020, a senior executive sold shares to the company in exchange for a vendor loan note. More recently, in Q2 2025, the company repurchased and reissued 817,730 shares for $2.8 million. These transactions indicate that the company is actively managing its share capital and seeking to reduce its outstanding share count. Concerns about inventory buildup and supply chain disruption. There are growing concerns regarding the stability of a company's supply chain. A specific mention is made on page 25, highlighting potential disruptions that could impact operations. Furthermore, an increase in fees receivable and accounts payable and accrued expenses on page 91 suggests possible issues with cash flow or inventory management. This accumulation of receivables and payables may indicate a buildup of inventory, which can be detrimental to a company's financial health. Such a situation can lead to difficulties in managing working capital, potentially straining relationships with suppliers and customers alike. The potential for supply chain disruptions and inventory buildup is a pressing concern that warrants close attention from management and stakeholders. That concludes the financial summary for ALTI Global Inc. Feel free to comment below, and I will be happy to answer them when possible.